Look, if you're a real estate pro or maybe a self-employed home buyer yourself, you probably already know the sheer frustration that comes with the traditional mortgage process. You've likely felt it firsthand, That exact moment a fantastic, thriving business owner gets told they don't qualify for a home they can easily afford. It is a massive pain point. It can literally derail dreams and kill deals. But today, we're going to fix that by walking through the definitive guide to qualifying self-employed buyers in this explainer.
Okay, let's dive right into this. Why on earth could a business owner pulling in $200,000 potentially qualify for less house than a standard W-2 employee making half that amount? I mean, it sounds totally backwards, doesn't it? It kind of feels like the whole system is broken. But the answer actually lies entirely in exactly how income is calculated and documented. Well, on one side, you've got your typical W-2 employee. Their world is pretty straightforward, right? Their gross income is sitting right there on their pay stub, and that's generally what lenders use. On the flip side, you have the independent contractor, the 1099 worker, the entrepreneur. The very thing that makes you a savvy business owner, taking smart, completely legal tax write-offs to lower your tax burden, actually hurts your taxable income. You're essentially penalized in the mortgage world for doing exactly what your CPA told you to do in the tax world. So for our path today, we're treating this explainer like a tactical training manual. We'll quickly cover the self-employed myth, gross versus qualifying income, alternative solutions, a realtor playbook, a real-world success story, and finally, the golden rule. All right, starting off with Section 1, the self-employed mortgage myth. If you've ever felt like the mortgage industry is just actively punishing business owners for being successful, trust me, you're not alone. That frustration is incredibly valid. But listen to this quote right from our source material. Self-employed buyers do not necessarily need a more difficult mortgage process. They usually need a more intentional one. This is such a critical reframe. Conventional qualification from entities like Fannie Mae usually looks for a solid 2-year history of self-employment. The analysis is based on actual tax returns and business cash flow, not simply what the borrower claims their business earns. So it's really not about being harder. It's about proving the numbers intentionally.
Moving on to Section 2, gross revenue versus qualifying income.
We really have to completely debunk the misconception that current high revenue guarantees automatic mortgage approval. Picture this. You're a realtor sitting across from a new client, and they confidently tell you, I make about $200,000 a year. Your immediate instinct? It might be to start calculating a price range based on that amazing number. But hold on, stop right there. You should literally never ever build a firm price range from this single vague phrase.
Why? Because honestly, that phrase could mean 6 wildly different things. It could mean $200,000 in gross business revenue, or just total deposits, or maybe it's income before business expenses. It could mean their personal income, a number on a 1099 form, or their actual taxable income. From a mortgage qualification standpoint, these are entirely different universes. And this proves exactly why a lender has to get involved to calculate the true qualifying number. Which brings us to Section 3, alternative documentation solutions. Now, what's really interesting about this slide is what happens when conventional tax returns just don't work, because the client took massive, completely legitimate business deductions. Let's dispel a massive myth right now. A lot of folks think bank statement loans are some sort of last resort product for borrowers with bad credit. Absolutely not. No way. They're actually a fantastic alternative method for highly profitable business owners with excellent credit whose tax returns just don't reflect their real healthy cash flow. Instead of using taxable income, lenders calculate qualifying income based on eligible bank deposits.
Let's anchor this with some actual math from the source material. Imagine a borrower whose business is depositing roughly $50,000 a month into their accounts. Now that is fantastic cash flow. But a lender can't just use that raw number. Businesses have expenses to keep the lights on, right? So how exactly do we get from $50,000 in deposits down to $25,000 in income? Well, the lender reviews those deposits and applies an expense factor. If the program uses a 50% expense factor, that $50,000 in gross deposits translates to about $25,000 a month in actual qualifying income. It's also super important to note that lenders will exclude non-income transfers, like, say, moving money between accounts or loan proceeds. This simple analysis completely changes the conversation from you don't qualify on paper to, hey, let's look at your actual cash flow. Another really powerful alternative is the profit and loss, or P&L, program. Certain programs allow qualifying income to be based primarily on a professionally prepared P&L statement rather than traditional tax return income. The exact requirements definitely vary. Lenders might need a specific self-employment history, supporting bank statements, or verification from a CPA, but the main takeaway here is that this option exists specifically to bypass heavily deducted tax returns.
All right, let's look at Section 4, the Realtor's Action Playbook.
So, we've talked theory, now let's get tactical. If you're a real estate agent, these are the exact actionable steps you need to take when you meet a self-employed client. And listen, you do not need to become an underwriter, you just need to ask these 5 simple questions to identify when a deeper review is needed. 1. How long have you been self-employed? 2. What type of business do you own and what is your ownership percentage? 3. How exactly are you paid? Like, is it 1099, owner draws, distributions? 4. Do you take significant business tax deductions? And 5. The absolute most critical one. Has a mortgage advisor already reviewed your actual income documentation? If the answer to number 5 is no, that is your immediate next step. Let's bring this to life in Section 5, a real success story.
I really want to prove to you that these alternative methods actually work in the real world to get deserving people into homes. Check out this story of a fellow realtor. She spends her entire life helping families buy homes, right? But when it was her turn, she hit a massive wall. She was earning about $160,000 a year on a 1099. On paper, it sounds super simple, but she had substantial business expenses. Her traditional tax returns just didn't show enough income to qualify. But instead of giving up, her mortgage advisor investigated the right documentation path. They reviewed personal and business returns and year-to-date P&L statements. The goal wasn't to just force her file into a rigid little box, but to actually understand her full income story. And guess what? They found an option that made sense, finally allowing the person who helps everyone else get a home to close on one of her own.
And that leads us perfectly into Section 6, the Golden Realtor Rule.
So the crucial point is this. If you take absolutely nothing else away from this explainer, you must remember this rule. Don't diagnose the loan. Identify the self-employed borrower and bring the lender in early. Seriously, the biggest mistake you can make is waiting until the buyer is already under contract to figure out how their income will be documented. Before you ever start showing houses, before you ever establish a firm price range, hand them over to a specialized mortgage advisor who can analyze their actual cash flow. I'll leave you with this final, provocative thought to really ponder today. Are you letting hidden qualifying income cost your self-employed clients their dream homes? Real people make real money while being self-employed. And with the right intentional process, that real income can absolutely translate into a real home. We just need to stop assuming a low tax return means a disqualified buyer and start finding that hidden income. Thanks so much for joining me on this explainer. Keep learning, keep asking questions, and I'll catch you next time.